Joining us now is TD Cowen President Jeff Solomon, now part of TD. His Cowen company was bought. Jeff, congrats on that. What sort of risks are lurking here? This doesn't sound like you.
Well, I mean, let's be real. I'm not sure there's a lot of risks. I mean, I think what we're seeing here, I agree with your previous comments, Sarah. The real issue here is the slowdown in lending. I think the Fed answered the bell here, particularly as it relates to, what happened with SVB and some of the other banks, being able to be in a position where you can provide liquidity and essentially ensure that depositors can get their money when they want their money. Like, I'm not expecting there to be a banking crisis. I think that the regulators have actually done a really good job at responding to the situation as it presented itself. The real issue here is what kind of a dampening effect this will have on the economy and whether or not this leads us into a recession. Certainly, if you're a bank today, you're probably looking at at slowing down your lending until you can see how things materialize here with regards to the economy.
So what is your feeling on the extent of that slowdown in lending? That's what appears to be the debate here. How severe this crunch is going to be?
Yeah, I mean, again, I just look at it. One of the big lessons that I think everyone's learned here is that duration is challenging for regional banks, right? And that's the banking business, right? You are to some extent borrowing short and lending longer. I think if you're sitting in an asset liability meeting today, and I'm not in those, just to be really clear, I'm on the securities side, so I'm just speaking from my own experience over time. You're definitely concerned much more about lending short or lending long and borrowing short. Right. And so you're just going to be a little bit more, I would say, a little bit more judicious with your lending. And we'll see how that plays out. And then one of the things that we should be on the lookout for is if there's credit deterioration as a result of that, you'll see banks continue to be a little bit more cautious.
Jeff, everyone sort of argues that banks are going to need to pay up on their deposit rates to stay competitive and keep people from migrating out to money markets or continuing to do so. But, I mean, I'm looking at charts of history. It's not like but overall bank deposit rates have chased money market rates over the years. I just wonder how much pressure you see in that in terms of from an earnings standpoint.
Yeah, so I'm not in the room on those kinds of conversations. I don't have a strong view on that. But we've seen these things before. So what happened here, it was a liquidity issue, and the Fed answered the bell on liquidity and providing liquidity. I don't think depositors have anything to worry about, and I don't think that there's a lurking bigger crisis on the horizon. I think banks will do what they need to do in order to drive their bottom lines, but I think at the same time, safety and soundness is really at the center of this. And so if they need to be in a position where you'll probably, if anything, you'll see a little bit more nuanced pricing. It's been a long time since the curve has given people an opportunity to distinguish between, let's say, overnight rates and demand deposit accounts and maybe like 3-month CDs or 6-month CDs or 1-year CDs. And so if I had any view at all, it would be that I think you'll see more nuanced pricing to attract deposits to match, I'd say, maybe the duration that the bank really wants to see. And that'll be a little more interesting, actually, for depositors because you'll be able to get maybe differentiated pricing on deposits up and down the short end of the curve between, let's say, 0 years and 2 years. And we haven't had that since the global financial crisis because it's been in zero interest rates forever, right? That's probably more likely the case. I wouldn't say wholesale you're going to see banks chasing. I don't know that that's the case.